Good evening, and welcome to today's market wrap. Let us start with a snapshot of how things are looking across global markets. It was a tale of two very different worlds today. On Wall Street, the mood was electric. The Nasdaq surged 2.78% to close at 25,122. The S&P 500 gained 1.66%, and the Dow Jones was up 1.19%. The VIX, which is the market's fear gauge, plunged 17%, a clear sign that risk appetite has come roaring back. The US dollar index broke below the key 100 level, now sitting at 99.97, down nearly 1%. The 10-year Treasury yield edged up to 4.66%. Offshore yuan strengthened against the dollar to 6.7453. Bitcoin followed the rally, up 1.42%, trading near 64,800. Crude oil slipped a bit to $84 a barrel. Spot gold had a good day, up 1.58%, at $4,169. So what was behind this surge? The main catalyst was a much stronger than expected U.S. second quarter GDP print, coming in at 4.2% initial estimate, versus the market consensus of just 3.1%. That data point essentially wiped away recession fears that had been hanging over the market. Combined with the Fed chair's dovish comments from a few days ago, these two tailwinds unleashed a wave of pent-up risk appetite. Money flowed heavily into tech and growth stocks as well as cyclical value names. The Nasdaq futures were up 3.3% before the cash open, confirming that this was genuine buying momentum, not a trap or a fake-out reversal. But if you look at China, it's a completely different story. The Chi-Next index, that's the growth board, tumbled nearly 4%. The Shenzhen Composite lost 2.73%. Only the Shanghai 50 managed a tiny gain of 0.39%. Why the divergence? On one hand, domestic economic confidence remains fragile. On the other hand, the escalation of U.S.-China tech restrictions weighed heavily. The U.S. is reportedly planning to expand AI chip export curbs, and China retaliated with restrictions on drone component exports. Instead of following the U.S. risk-on mood, capital in China rotated into defensive blue chips. Let us step back and look at the global flow picture. The weak dollar is positive for risk assets, U.S. stocks rallied, and Treasury yields edged up modestly, confirming the market is pricing a recovery trade, not a stagflation scenario. But China A shares did not participate, creating a clear divergence pattern of global risk-on, China independent weakness. What does this mean for tomorrow? There is a chance for a shares to play catch-up, but it's more likely we will see continued structural divergence, with the Shanghai 50 supporting the market while small and mid-caps remain under pressure. The weak dollar provides some buffer for yuan-denominated assets, but the core issue remains domestic confidence in the economic outlook. For U.S. stocks, the tech rally got a macro data confirmation today, but whether it can sustain depends on upcoming earnings reports and how the September rate cut expectations evolve. For now, we can only call this a data-driven one-day bounce. Continuity needs to be verified. Looking at tomorrow, we assign only a 20% probability of further upside, 20% probability of downside, and a 60% probability of a sideways consolidation. Keep your positions light, don't chase the rally, and wait for clearer signals before committing more capital. That's all for today's report. Thank you for watching, and we will see you tomorrow.